Welcome to the deep dive. Today we're looking at some source material you shared, and it tackles something, well, pretty stressful for anyone with investments. What do you actually do when a stock price starts to drop?
Yeah, it's a real moment of truth, isn't it? Especially if you're maybe newer to the markets. Seeing those red numbers, it can feel quite unsettling.
Absolutely. And this source lays out two really different ways to react. So our mission today is to unpack what the source says about these strategies, stop loss and averaging down. What are they? How do they work? The pros, the cons.
And crucially, who the source thinks they're best for, particularly keeping in mind someone, maybe like yourself, who's still finding their footing as an investor.
Exactly. So let's start with the first one the source talks about, stop loss. What's the basic idea there?
Well, the source defines it pretty clearly. It's about setting a predetermined price beforehand, a price where you automatically sell a stock you hold.
Right. So the core aim, according to the source, is basically protect your money, right? Limit how much you can lose.
Precisely. So the example they give, you buy at $100. You decide, okay, I can handle maybe a 10% loss, but that's it. So you set a stop loss order at $90.
And if the price actually hits $90, boom, it sells automatically.
Yep. It triggers the sale. You lock in that 10% loss, but you avoid, potentially watching it fall even further.
Okay, I see the appeal. The source points out the big pros are it forces discipline, takes the panic out of it.
Exactly. Discipline is key. You set a rule, you stick to it. Very useful, the source says, especially when markets get choppy and volatile.
But
yeah,
there's always a but, isn't there? The source mentions this risk of being whipsawed. What does that actually mean?
Yeah, that's the main downside highlighted. It's when, say, the price dips just low enough to trigger your $90 stop loss. You sell.
Ah, okay.
And then almost immediately it bounces right back up. Maybe it was just a temporary blip, some market noise.
And you're out. You sold the bottom and missed the recovery. Ouch.
Exactly. That's the whipsaw. It can be incredibly frustrating.
So who does the source suggest this stop loss approach is generally better suited for then?
Mostly short-term traders, the source indicates, or investors who are just generally quite risk-averse. And it really emphasizes this for novices. If you're unsure, if you're new. Stop loss is presented as generally the safer bet to manage that downside risk.
Okay, that makes sense. Safer, but you might miss a rebound. So if stop loss is about selling when prices fall, the source then talks about averaging down, which sounds like, well, the complete opposite.
It pretty much is. Instead of selling when the price drops, averaging down means you actually buy more shares of that same stock as the price is falling.
Wait, buy more? Of something that's losing value. That feels wrong somehow after just talking about limiting losses.
Yeah.
What's the logic?
Well, the source explains the objective isn't immediate loss limitation. It's about lowering your average purchase price for all the shares you own.
Lowering the average. How does that work?
So the source uses this example. Let's say you bought 100 shares at $100 each. The price drops to $80. Instead of selling, you buy another 100 shares at $80.
Okay. So now you have 200 shares.
Right. And you spent $10,000 in the first lot, $8,000 on the second. That's $18,000 total for 200 shares. Your average cost per share is now $90, not the original $100.
Ah, I see. So mathematically, your break-even point is lower. The stock doesn't need to climb all the way back to $100 for you to get back to even.
That's the main advantage highlighted, yes. Lower break-even. And if the stock does rebound strongly, you potentially make more profit because you own more shares bought at that lower average price.
But the risks must be higher too.
Oh, significantly. The source is very clear on this. The big danger they flag is catching a falling knife.
Meaning, you buy more and it just keeps falling.
Exactly. You keep averaging down, thinking it's cheap, but it just keeps plummeting. You end up throwing good money after bad, increasing your exposure, and tying up way more capital in a losing position.
Right. So, definitely not for everyone. Who does the source say should consider averaging down?
It's really positioned for long-term investors. People who've done serious homework on a company, have really strong conviction in its fundamental value, and believe the market's just got it wrong temporarily.
And you need the money to do it, obviously.
Yeah.
and the stomach for it.
Definitely. The source stresses it requires capital, patience, and real conviction, not just a hunch.
So, looking at these two side by side, the source really paints them as fundamentally different philosophies, doesn't it?
Completely different mindsets. One's about defense cutting losses, preserving capital with a clear exit rule, stop loss.
And the other is about offense, almost. Doubling down on your belief, accumulating more when it's cheaper, accepting more risk for potentially more reward later, averaging down.
That's a good way to put it, and the source issues a pretty strong warning about trying to mix them haphazardly without a clear plan. You really need to know why you're acting.
Are you trying to protect what you have, or are you convinced this is a buying opportunity? Those are very different goals.
They are. And for anyone navigating this, especially novices or even experienced investors who are just unsure about a particular stock's future, the source guidance leans towards stop loss as the generally more disciplined, risk-managed approach upfront.
Okay, so thinking about these two distinct paths the source presents for dealing with falling prices, one about cutting losses fast, the other about leaning into your conviction. What does that really tell you, our listener, about the importance of knowing not just what companies you're investing in, but having a clear understanding of why you're investing in them in the first place? Something to consider.